Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HUT8.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, please do, because today we have a really fascinating setup to talk about.
Oh, absolutely. I mean, to really set the stage for your portfolio today,
Yeah.
we have to look back at what happened in May of 2026.
Right.
Because we basically witnessed this massive real-time identity shift for HUT8, which trades under the ticker symbol HEQT.
And if you were watching the markets, you saw this stock just completely explode.
Yeah, we are talking about a 64% surge in a single month.
Which is wild.
Right, and that kind of violent upward price action, it doesn't just happen in a vacuum. It happens because the fundamental narrative of a business is being completely rewritten.
It really is. I mean, the broader market is finally waking up to the fact that they are no longer just this volatile, unpredictable crypto mining operation.
Right.
They are actively pivoting, and they're doing it really aggressively, to become a massive AI infrastructure gatekeeper.
Yeah, they're building the actual physical high-capacity foundation that the artificial intelligence revolution absolutely needs to function.
Exactly. But before we really break down exactly how they're pulling off this pivot, I want to mention a really useful chart tool for you guys.
Yeah, especially with stocks making these kinds of massive, volatile moves.
Right. So if you want help reading your trading charts more clearly, you can check out VIP Algos. The link is right down below in the description.
It's a great setup.
It is. It's a TradingView indicator suite, and it gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even areas for take profit and stop loss planning.
Yeah, and you can use it across a bunch of markets, stocks, Forex, crypto, gold, indices, futures, all of that.
Just remember, though, VIP Algos is purely an educational chart analysis tool. It's not financial advice, it does not place trades for you, and it definitely does not guarantee profits.
Right. Trading involves real risk, so always manage your risk and do your own research. And just a quick note, that is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Right. So getting back into it, let's move into the wealth building context here.
Okay, yeah, because when you're looking at your long-term portfolio, you're usually trying to identify the undeniable macro trend, right?
Yeah.
And right now, clearly, that is the AI supercycle. But there's this massive bottleneck forming that I feel like a lot of people are just ignoring, which is severe power scarcity.
Oh, absolutely.
I mean, you can design all the hyper-advanced processing chips in the world, but if you don't have the electricity and the specialized physical data centers to power them, they're basically useless.
They're paperweights.
Exactly.
Yeah.
And that is the exact scarcity HUT8 is targeting. They're positioning themselves as a high beta growth and infrastructure play.
Right. And to understand why a former crypto miner is perfectly positioned for this, you have to look at what miners actually do best.
Which is what? Hunting down power.
Yeah, exactly. They spend years hunting down massive, cheap, stranded power sources. They secure the land, they negotiate the utility contracts, they build the electrical substations.
And that early legwork is incredibly difficult and time-consuming.
It really is. So now, instead of using all that precious power just to mine Gitcoin, they are retrofitting and expanding those sites into high-tier data centers.
Okay, but I hear the words AI supercycle, and I have to admit, a little alarm bell goes off in my head. I have to push back a bit here.
Fair enough.
It feels like every single company on the planet right now, especially the ones coming from the crypto space, is just slapping the letters A and I onto their pitch decks.
Just chasing the hype train.
Exactly, just to inflate their valuation. So how can you be sure this isn't just a clever marketing campaign from a miner looking for a quick stock bump?
It's a completely fair skepticism, but if you look at their physical strategy, you can see it isn't just fluff. They are executing what they call a power-first strategy.
Meaning what, exactly?
Meaning they aren't just out there buying servers and renting space in someone else's building. They are vertically integrating the actual energy origination with the data center construction.
Oh, okay.
Yeah, they're positioning themselves as a literal gatekeeper for AI's most critical constrained input, which is the power itself. If you control the power at the source, you control the access.
Okay, so the takeaway for you as an investor listening to this is to evaluate this not as a short-term crypto trade, but as a multi-year infrastructure growth story.
Exactly.
But if that power-first strategy is actually working, We shouldn't just be hearing about it in forward-looking press releases. We should see that pricing power immediately reflecting in their numbers.
Right.
Are we actually seeing that transition in the fundamentals?
They absolutely are, and it's showing up rapidly. Let's look at the first quarter of 2026.
Okay, lay it out.
Their revenue surged 226% year over year, hitting $71 million.
Wow, 226%.
Yeah. But top-line growth is really only half the story here. The really compelling part is the profitability of that new revenue.
The margins.
Exactly. Their overall gross margins expanded from a relatively thin 14% all the way up to 64%.
Going from 14% to 64% is, that's essentially a completely different business profile.
It is. And if you isolate just their compute segment...
Which is the part focused purely on the AI and high-performance computing, right?
Right, exactly. That specific segment margin is sitting at an incredible 67%.
We really need to explain the mechanism behind that margin jump, because I think it highlights the core difference between crypto and AI infrastructure.
Definitely.
Because crypto mining margins fluctuate wildly. If the price of Bitcoin drops or if the local cost of electricity spikes, your profit margin can just evaporate overnight.
It's super unpredictable.
But AI computing operates on fixed, long-term commercial leasing contracts. Once that data hall is built and the client servers are plugged in, you have locked-in recurring revenue for years.
It essentially transforms a company from a speculative mining operation into a highly predictable commercial real estate play.
Yeah, that's the perfect way to look at it. It's digital real estate.
Exactly.
Okay, but I'm looking at their consolidated financial statements here, and there is a massive glaring red flag that we have to talk about.
The net loss.
Yeah. The trailing 12-month net loss is sitting at $311 million. I don't care what the gross margins are in one segment. A $311 million loss does not look like a healthy company.
It looks terrifying until you unpack the accounting distortion behind it.
Okay, explain that.
Out of that $311 million loss, $253 million of it comes entirely from unrealized Bitcoin mark-to-market losses.
Let's translate that for a second. Because they hold Bitcoin on their balance sheet, accounting rules force them to record any drop in Bitcoin's price at the end of the quarter as a financial loss on their income statement.
Right. Think of it like owning a rental property. Imagine getting your house appraised every 3 months, and if the housing market dips, you are forced to report that drop in home value as a massive loss on your personal income taxes.
Even though you haven't sold the house and you're still collecting rent every month?
Exactly. It's a paper loss. And right now, that crypto accounting noise is severely distorting the actual operating performance of their high-margin data center leases.
Right. But even if we strip away the paper losses, there is still genuine financial stress here.
Yeah, there is.
If we look at the parent company level, things are really tight. They only have about $160 million in cash.
Which isn't a lot for infrastructure.
No. And their Altman Z-score, which is a metric used to predict the likelihood of bankruptcy, is sitting near 1.71.
Yeah, that's widely considered distressed territory.
On top of that, they have an active $1 billion at-the-market, or ATM, equity program.
Which is essentially just a mechanism for share dilution.
Exactly. It's an open faucet. It allows the company to continuously print and sell new shares into the open market whenever they need cash.
Right.
For you, as an everyday retail investor, every time they tap that program, your ownership stake gets diluted. You own a progressively smaller percentage of the company.
That is the grim reality of the parent company, yes. But evaluating this business requires a complete bifurcation.
Meaning what?
You have to separate the parent company from the project level. The project level is where their true competitive moat actually exists.
Okay, walk us through that.
They have successfully secured $7.5 billion in investment-grade, non-recourse senior secured notes for their massive infrastructure builds.
Wow.
Yeah. That breaks down to $3.25 billion for their Riverbend project and $4.25 billion for the Beacon Point project.
Non-recourse is the critical term there, though.
Yeah.
To use another real estate analogy, think of it like setting up an independent LLC to buy an apartment building.
Right.
If that specific building goes bankrupt, the bank can repossess the apartment, but they cannot come after your personal checking account.
Exactly.
That is what Hut 8 did here at a multi-billion-dollar scale.
Oh.
That debt is tied exclusively to the individual data center projects. They firewalled the parent company from the project debt.
And what is really staggering is that they secured that $4.25 billion at a BAT2 investment-grade rating from Moody's.
Which traditional crypto miners can't get.
They simply cannot do it. Their traditional peers do not have the credit profile to access this kind of massive scale, cheap institutional capital.
Right.
It proves that traditional, highly conservative credit markets genuinely believe in their ability to execute these AI mega projects.
So the capital is secured, which bridges us perfectly to the timeline.
Yeah.
We know the money is there, but when does this pivot actually materialize?
Good question.
What is going to move this stock over the next 3 to 18 months?
First up on the catalyst timeline, we have Q2 2026 earnings coming up in August.
Okay.
The market is going to be hyper-focused on proving that the 67% compute margin wasn't just a one-off fluke. They need to show that the $71 million revenue pace is stabilizing and, ideally, accelerating.
But the real heavy hitters are the construction milestones.
Absolutely.
They are targeting the energization of their 1 gigawatt Beacon Point campus for the first quarter of 2027, with initial data halls expected to be delivered by the third quarter of 2027.
Right.
So any near-term updates regarding utility interconnections or substation progress, those are going to act as immediate binary catalysts.
And we should clarify what energization actually means in this context, because it isn't just flipping a light switch.
Definitely not.
It is the incredibly complex physical process of safely connecting a massive, newly built electrical substation to the regional power grid. They have to test the transformers and ensure the local grid can handle the sudden, massive draw of electricity without causing blackouts.
And a 1 gigawatt draw is monumental.
It's massive.
To put 1 gigawatt into perspective, that is enough electricity to power a medium-sized city.
Yeah.
A traditional cloud data center might run on, 20 or 30 megawatts, but these new AI server racks, specifically the ones running NVIDIA chips, they are so dense and run so incredibly hot that a single facility needs exponentially more power just to keep the chips from melting.
Right. And Hut 8 is building one of the very few places on Earth that can actually handle that kind of concentrated thermal and electrical load.
Alongside that physical timeline, though, there is a major macro catalyst unfolding. We are actively witnessing the decoupling of Bitcoin miners from spot Bitcoin prices.
Yeah, the institutional rotation.
Exactly. Institutional capital is rotating out of pure speculative crypto plays and moving into these tangible AI infrastructure equities.
And the forward estimates definitely reflect that optimism. There are projections out there showing them reaching $1.6 billion in revenue by 2029.
But I have to ground this conversation for a second. We're talking about energization in early 2027 and major revenue realization in 2029. Is the market getting way ahead of itself? I mean, the stock is commanding a massive premium today for capacity that won't even be plugged into the grid for another year. We're essentially paying top dollar for a construction site.
It is a premium, without a doubt.
Yeah.
And when you look at the chart, you see exactly how aggressively the market is pricing in that future value. That 64% surge we saw in May of 2026 has pushed it right up near record territory.
Structurally, what is most fascinating about the price action is that the stock is actively breaking out of its historical Bitcoin-correlated trading ranges.
Finally.
Yeah. For years, the rule is simple. Whatever Bitcoin did, this stock did. If Bitcoin crashed, Hut 8 crashed. That chain is finally breaking.
But shedding that correlation hasn't reduced the volatility at all. The stock's beta is currently sitting above 6.
Let's break down what that means for your portfolio. The broader market, say the S&P 500, has a beta of 1.
Right.
A beta over 6 means that if the broader market drops 1%, you should brace for this stock to swing 6% or more.
It's a wild ride.
It really is. It experiences incredibly violent, whiplash-inducing intraday and weekly swings. It is highly sensitive to the broader sentiment in both the AI sector and the lingering crypto markets.
Yeah.
For instance, volume just completely exploded following the pricing of those $4.25 billion Beacon Point notes.
When you are dealing with a beta that high, you are navigating extreme chop. That kind of volatility is exactly why traders often rely on clean chart workflows to map out historical support and resistance zones. You need a visual anchor, so you aren't just flying blind when the stock swings 10% in a single afternoon.
Which is where mapping out the broader market psychology becomes so crucial. We know the stock is volatile, but what is the actual sentiment driving that volume?
It's overwhelmingly bullish right now.
Yeah, and it is being driven by heavy institutional accumulation. Smart money is moving in.
We saw billionaire Dan Loeb's Third Point hedge fund recently initiate a new position.
Wow, okay.
Yeah, and when funds with that level of capital and research capability step in, it signals deep institutional conviction in the infrastructure transition.
Definitely.
We also saw fixed income markets massively oversubscribed to those debt raises. Institutional credit investors are notoriously risk-averse. They do not hand out billions of dollars without exhaustive, microscopic due diligence.
But here is where the sentiment picture gets really fascinating. There's a massive shadow catalyst looming over this stock, a highly speculative rumor.
The tenant rumor.
Yes, the anchor tenant for the Beacon Point campus is strictly confidential. In all the official filings, they're only described as a high investment grade company.
Right. But Simply Lawson recently referenced a 15-year, $9.8 billion IT capacity lease with NVIDIA regarding Beacon Point.
Think about the mechanics of that for a second. If that rumor is officially confirmed, if NVIDIA is actually the anchor tenant signing a 15-year, multi-billion-dollar lease, it fundamentally de-risks the entire massive construction loan.
It's a game changer.
It guarantees the revenue before the concrete is even fully poured. That is a massive speculative catalyst that traders are trying to front-run right now.
It is an incredibly exciting prospect, but we do have to temper the mood here because not everyone is buying the hype.
Right, the bear's up there.
There are bearish analyst notes circulating that point out the stock is now very richly valued based on perfect future execution. And despite all this AI pivot talk, they are still highly dependent on near-term Bitcoin cash flows just to survive the transition phase until these data centers are actually built and generating that lease revenue.
Which brings us to the reality check. We have to lay out the downside risks clearly, because in multi-billion-dollar infrastructure, there is no such thing as a sure thing.
The single biggest threat here is pure execution risk.
Right.
The entire premium valuation of the stock right now relies on them successfully delivering 577 megawatts of complex AI capacity by the second or third quarter of 2027.
And when you are building infrastructure at this scale, things go wrong.
Oh, always.
If there are massive supply chain breakdowns for specialized transformers, if there are labor shortages, cost overruns, or if they run into local permitting and zoning disputes that just halt construction, it would be devastating.
Yeah, the current stock price assumes they execute this transition flawlessly.
Yeah.
Any delay punctures that premium.
There is also the issue of dilution and fragility that we touched on earlier. You cannot ignore the parent company's weakness.
The ATM program.
Yeah, they have that $1 billion ATM program. As we discussed, that virtually guarantees future share dilution for retail investors. The parent company needs cash to bridge the gap to 2027, and they will likely get it by issuing new shares.
And let's not forget the crypto drag. While they are pivoting, they still have consolidated cash flows tied up in their legacy Bitcoin operations.
Right.
A sudden, severe drop in crypto markets could still choke their near-term liquidity, which would severely complicate their ability to fund the day-to-day corporate operations while the mega projects are being built in the background.
So, with all the data, the fundamental shifts, and the looming risks on the table, what is the final verdict based on our analysis?
Looking at it objectively, the bullish score comes in at an 8 out of 10.
Okay, the 8 out of 10.
Yeah. Our final stance is that this is a highly compelling, high beta long position that is perfectly positioned to capitalize on the massive power demands of the AI infrastructure supercycle.
But it's important to define the time horizon.
Yet,
The long-term view here is that this is a multi-year hold. You are holding through the 2027 campus energization and the subsequent lease monetization. This is not a stock you buy hoping for a quick, smooth flip next month.
which dictates the investor fit, right? This is a great opportunity for investors who have a high risk tolerance and are looking to gain exposure to a generational infrastructure pivot.
If you want to ride the physical wave of AI power demand, this is a very direct avenue.
Exactly. However, this is a terrible fit for conservative investors who are looking for safe, immediate, cash-flowing dividend plays.
Oh, absolutely.
The extreme beta here will absolutely shake out anyone who doesn't have the stomach for a rocky, volatile ride.
And of course, a clear reminder that this talk is not financial advice. You must do your own research, understand your own risk profile, and map out your own plan before jumping into an equity with a beta over 6.
Yeah, definitely.
And if you want a cleaner way to map out those charts and manage that extreme volatility, you can check out VIP Algos through the link below in the description.
It's a really solid tool for that.
It is. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can really help make complex charts easier to scan.
But remember, it is still only an educational chart analysis tool.
Right. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk appropriately.
And again, this is an affiliate link, and we may earn a commission at no extra cost to you.
Right.
And if today's deep dive helped you, please subscribe, like, and comment underneath. We'll see you next time on Smart Wealth with Joshua.
But wait, before we sign off, I just want to leave you with one final thought to mull over.
Oh,
Yeah, we talked extensively today about this fierce race to secure grid power for AI. But what happens when the legacy utility grid these companies are tapping into reaches its absolute physical limit?
that's a scary thought.
It is. As these massive gigawatt campuses come online across the country, will the next great competitive moat simply be the ability to generate massive amounts of power completely off the grid? It's definitely something to think about as you watch this incredible space evolve.